is the first of what we hope to be many more learning books to come, capturing and reflecting on what we are learning as we go. I'm joined today by an exceptional panel of leaders who bring diverse and deeply insightful perspectives from across the investment and impact ecosystem. And maybe I would like them to introduce themselves at this point. Maybe we start with Joy-san.
Hello, good afternoon, everybody, wherever you are. I hope you can hear me clearly. I'm Joy-san Wainaina. I'm the managing partner of Chewy Ventures, a Pan-African seed fund investing in local founders building tech-enabled solutions that drive financial inclusion and market efficiencies across sub-Saharan Africa. We take a gender-inclusive approach, and we are currently at 50-50 male and female founders, which we are very proud of. More of that to come.
Thank you, Joy-san. Patrice, over to you.
Thank you. My name is Patrice Backer. I'm a partner and chief investment officer at AFIC Funds. We are an Africa-focused private equity fund management company. We've been in the investment space in Africa since 2006, and we are a generalist fund manager, but we've developed special expertise in financial services, in agribusiness, and in FMCG investments. Thank you.
Thank you, Patrice. Elizabeth?
Hi, everyone. Welcome to all the attendees. Great to see so many familiar faces. I'm Elizabeth Howard, and I'm joining you from Cape Town, South Africa. I'm the founder of Lelapa, which is a consultancy that works at the intersection between capital markets regulations, SME finance, and networks for systems change. I'm the founder of a network of investors called Women in African Investments. We're about 300 senior female investment professionals all over the continent. And I'm also a founding director of the African Crowdfunding Association, where our focus is accompanying African regulatory authorities in implementing regulatory frameworks for investments crowdfunding. Happy to be here.
Thanks, Elizabeth. And Joy.
Hello, everyone. My name is Joy Anderson. I am the founder and CEO of a global think tank, Criterion Institute. We work in the field of gender lens investing and have been a consortium partner within the Mastercard African Growth Fund since the beginning. One of our core slogans as an organization is to fix the capital, not the company, and really focused on how do we actually design the investment vehicles that work in context, full stop.
Thank you very much, Joy, and thank you to all our panelists. It's really, really exciting, and I'm excited to have you all. I can see we have right now over 160 participants, and maybe to just do a check-in into all our participants. Can you do two things for me, please? First, can you use an emoji to describe how you're feeling at this moment? And then maybe in the chat box, maybe also introduce yourselves so that everyone else here can know who you are, where you work, and where you're dialing in from. Exciting, exciting, exciting. Okay. Great. A lot of thumbs up, a lot of love in the atmosphere. Okay. Great. So let me also take the moment to very quickly introduce the Mastercard Foundation Africa Growth Fund. And maybe in the conversation, you would hear me say the fund. So when I say the fund or anybody says the fund, we're referring to the Mastercard Foundation Africa Growth Fund. So the fund is a $200 million fund of funds established to catalyze capital through investment vehicles with a gender lens investing approach. The fund was established to achieve three key things. First is to invest capital into women-led investment vehicles and SMEs that are African-owned and African-led. Secondly, the fund was established to create dignified and fulfilling work for young women on the continent. And I would say at this point that that's actually the North Star of the fund. And then thirdly, the fund was established to influence the ecosystem in ways that shift power, shifts who gets to invest and who is invested in across the continent. And so the fund operates in a consortium led by MIDA. MIDA is the Mennonite Economic Development Associates. And then we do this in partnership with ESP partners, Criterion Institute, Genesis Analytics, and ACG. I think if you go to the fund's website, you see a bit of more information about all of our partners. And from the beginning, it was built as a learning prototype. The fund essentially is a learning fund. And so that's why this is important. So it's an intentional effort to test, to adapt, and iterate in real time while also deploying capital. And so the fund has just begun its 4th year. And so far, the fund has made investments into 16 investment vehicles across 8 countries with a portfolio footprint of 88 SMEs across 13 companies. And together, they've created over 8,300 jobs, with 40% of those jobs being women and about 30% young people. Essentially, like I mentioned earlier, the fund's North Star is to create dignified and fulfilling work. So we're not just counting numbers, we're actually looking at the quality of these jobs, and especially for young women on the continent. And I think it's important to know that all of our partners on the fund, as well as the investment vehicles and portfolio companies, around the fund, we are all vehicles, working towards ensuring that young women on the continent can live long and live well. And so that's why this learning really, really matters. And today we are reflecting on not only what we've done or what we call our wins, but also what we've learned in the last 3 years. And so on this note, I would like to hand over to Joy Anderson, the president and founder of Criterion Institute, who will unpack the learning book and kick off the conversation. Joy, over to you.
Thanks so much, Femi. So I'll do a couple of things in a preliminary overview. First of all, to talk about the methodology of the report. Second is to walk through a few of the insights, and then some of the ways that we thought the report would actually be useful, because in many ways, this is an example of a group of people learning out loud. As we all sit inside of our organizations or inside of partnerships or consortiums, we talk about what we're learning, and we often talk about that to each other. The purpose of this learning book and the commitment that Dorothy Yimbe made from the beginning, which is that we would learn and we would share with the ecosystem what we're learning, even if that's hard. And so this is not an evaluation, right? This is not a look at how we're doing. This is a reflection about what we're learning as we're doing. And it combines the reflections of all of the consortium partners. So this is pulled from many different pieces, although it ended up being authored to have a single voice. And so it pulls from Genesis's extensive work as the learning partner within the fund, from ESP. I see Charity's part of on the list of people here, ACG, who's hosting this, and of course, Maida, and just a shout out to Femi, who leads the learning across all of this and is just a remarkable leader inside of the fund. So the way we put this together is to the basic outline of the report, and apologies that it's 66 pages. We're going to work on other ways to package it, but it covers 4 different things. It covers how we established the pipeline, established the structure, which was no small feat, right? It's a Canadian INGO partnering with Mastercard Foundation, with then consortium partners on the continent, and on and on. It's actually not a simplistic structure. So establishing the structure, building the pipeline, analyzing risk and opportunity in due diligence that lets us lead to decision making, and then structuring the investments. So not rocket science, it sort of follows the basic path of investing. But this one is focused on not only the investing, but the early process of standing up the fund, figuring out how we were going to invest. And we are 3.5, 4 years in, and a bunch of that time was actually to get organized. We will write there's going to be a total of 4 books that we write within the next 9 months or so. The next one will be on value creation, leaning heavily on the work that ESP has done as part of that. The next will be on ecosystem engagement. And then finally, we'll look at the context of building jobs in local economies, and which in the end is building jobs for young women is what we're trying to do to actually build stronger economies, stronger businesses within those economies that create the kinds of jobs young women want. So as we structured this report, 3 tensions emerged, and that's the analytical structure of the piece. So the first tension is one of the things that I find hardest as working in investments and also wanting to create systems change, is that you need to confidently execute while learning and adapting. And within the norms of finance, there is significant pressure to know what you're doing at all times, because you're managing other people's money and you're making investment decisions. But at the same time, we have to be learning, because most capital doesn't actually work. It needs to be shifting. It needs to be changing. We wanted to be learning. And so one of the pieces one of the examples for us is we needed to create an extraordinarily strong governance structure that worked across consortia, worked across continents, that lived up to the Mastercard Foundation's expectations, but also the board of MEDA and others. We needed to have that strong, coherent consistency, but we also needed to bring in different voices, different ways of thinking, and just the thing out of that I always take away from these kinds of references is confidence is often tied to privilege. The people who speak with the most confidence are often the same folks who come from privilege, and therefore figuring out how to make sure other voices are heard becomes essential. And along with that is also making sure that there's open space to sort of prioritize time for learning, even if learning doesn't feel like the most urgent thing. So that leads me to the second point, which is about balancing the urgency of direct impact with the ability to create systems level change. And these two are often sort of in juxtaposition or in conflict with each other, because we want to create the urgency of creating jobs and meaningful jobs, dignified jobs, is paramount for so many people's work. And yet, if we're not also paying attention to the systems around the systems of capital and other pieces that move money that create those outcomes. So we're in this tension where we recognize the urgency. We need to move capital. We need to move capital quickly, but we also need to build capital structures that work. I think one of the pieces within this that was most pronounced was the fund's commitment to domiciliation, committed to having funds that are domiciled in Africa, and sometimes that slowed things down. People to be able to receive our capital needed to domicile in Africa. And that's critically important so that African capital stays in Africa, and the infrastructure in Africa, to Elizabeth's work and many others, stays in context. But that wasn't the fastest path. And so keeping those kinds of balances in place. I think one of the broader long-term lessons is how do we use the power of signaling? I think with the domiciliation, one of the pieces of systems change that got created was out there in the world, and now with the report and other pieces that are coming on from our domiciliation work overall, being able to say this is critical and signaling that is actually a form of systems change. So finally, and this is probably the one dearest to my heart because it is about power, is about challenging the norms of the system while working in the system. And one of the pieces around this that probably was most highlighted was investment readiness. And in the continent right now, there's a broad dialogue about who is investment ready. One of the things that we learned as we went through this, as we looked at ourselves and as we looked at what's happening in the ecosystem, investment readiness is about being able to take in capital. What's interesting about that is it kind of the measure for being ready is being ready for the current system. So the measure of being ready is that you're able to work in the current system. That becomes a self-fulfilling prophecy to make sure that everybody can work in the current system, which is super important because we need to move capital now so that we can create jobs and have stable investment vehicles. But we also need to challenge those norms and say, hey, maybe not being able to work in the current system means you're doing something right because you're challenging the system. So how, as an ecosystem, do we see the norms? Just see them. Notice that we're operating within a system of norms and that those can and should be challenged and be changed. So Femi, I'll come back to you.
Yeah, thanks, Joy. And maybe you've already prompted the first question I wanted to, ask to the panelists. And maybe I want to start with you again, but in 2 minutes, right? And I like that. I think one of the things I like that you've talked about is the three tensions. So, and the three tensions are executing while learning, creating direct impact while shifting systems, and challenging norms, which was your last point, while working within them. So can you, unpack that a little bit, and then I'll ask the same question to the panelists to just open the floor. Over to you, Joy, 2 minutes. Yeah.
Well, and I'll be shorter than that in some ways. And for those of so many of you who are on this call, work inside of the field of gender lens investing. And I think that's maybe where I see this tension the most, because in some ways, gender lens investing has two projects within it. It's both to ensure inclusion of women into the current system and to ensure that the current system changes so that it can address the power dynamics within it. It can address the analysis that is wrong, right? Incorporate new data. So there's always this balance between a systems goal, which is including more people within the system, which means you're working within the existing norms and you're making the business case for women that's about how people currently see the business case. But then challenging that is also to say the system of capital doesn't work for many people, and it particularly doesn't work. It was not designed for the continent, and it has many adaptations that need to happen or transformations. So inclusion, but also transformation.
Thanks, Joy. I think I would shift to Patrice now. The tensions that we've mentioned here, how does it resonate with the work that you've been doing over the years?
Sorry. Well, thanks, Femi. Let me start by commending the Mastercard Foundation, MEDA, and the partners for publishing this learning book. I think it's extremely critical that we document our lessons from investing so that we can improve our industry and adapt it to our local realities. I think we at AFIC Funds, we do this, but in a much less public fashion. So that's I wanted to state that up front. The three core tensions from the learning book that Joy just described, they resonate very deeply for us. We've been investing over the past 19 years. So let me just take them one by one and quickly tell you how they resonate. With respect to executing while learning, we've always understood that Africa is absolutely not a plug and play environment. Every investment is a live experiment, basically, in navigating a fragmented market, regulatory uncertainty, and limited or challenging infrastructure. So it's important that we execute with the discipline of global fiduciary standards if you have international investors, but it's almost like you're building the road while you're driving on it at the same time, right? So you have to be able to do what you need to do, but you also have to learn, sit back, and reassess. So that happens whether you invest in first-time entrepreneurs, family businesses that are transitioning. You need to be able to adapt. And in our case, we've institutionalized this learning by building fairly strong post-investment engagement models with the portfolio companies. That's certainly one way to do it. Also, when we talk about creating direct impact while shifting systems, at Afik Funds, and we've said that forever, we've long believed that creating jobs and increasing the disposable income of the employees of our portfolio companies is probably one of the most meaningful impacts we can have. But that's not enough. I think true impact comes when the underlying system also changes. So if, for example, if the companies we're backing inspire local banks to create a new lending product, you know how conservative banks in Africa are. I think that's a shift. If our track record is able to catalyze pension funds, local pension funds, to participate in private investments, that's a shift because they're notoriously conservative. So, we've tried to design our funds as vehicles for demonstrations, but it requires patience and a commitment to more than just IRR. So system changes take a long view. I think the foundation recognizes that, and it must be baked into your investment thesis literally from day one. And last but not least, the challenging norms while working within them, it's probably the toughest. Let's be realistic. The norms of global capital are still defined in New York, London, mostly Western countries. They're not defined in Lagos or Dakar or Nairobi. As African fund managers, we constantly navigate this tension. We've had to explain why we source a different way from what the management consulting firms tell you, or why a Black-led fund with deep local roots should be seen as a premium feature and not as a risk, right? I mean, that's a challenge. But we also recognize that to attract institutional capital, you need to speak the language, provide audited financials, explain the risk of your returns, have a strong ESG framework. So we've worked within the system, but we also challenge it. So I think in closing, I see these tensions personally not as problems to be resolved, but they're design constraints that we have to manage. We have built our strategy around navigating them, and we believe that, frankly, that's what it's going to take to truly shift capital and shift power in the African landscape. So I had more to say, but I think in the interest of time, I'll just stop here.
Thank you, Patrice. Over to you, Joy-san. Which of these tensions resonate with you?
Okay, I think a lot has been said, and I really love the opening statements that Joy gave about learning out loud. And really, this is what we're doing now, trying to share our learnings, our experiences. And a lot has been said by Patrice, so I'll try not to replicate. But for us, we were really trying to design investment vehicle, to design a fund for local impact. That is why Chewy was born. We chose to start a fund that does a couple of things. We invest in local founders. We invest with a gender inclusive lens. We don't apologize for any of these things. We looked at local capital to back us initially. So let me just speak to a couple of those things. When we start with, say, we start with the context of what we're trying to do, not so much on the capital structures, right? So at Chewy, we don't start by asking how to fit African startups into the traditional VC model. We start by understanding the local realities. And because remember, we are trying to invest in companies that are fairly early stage. They're not ripe for real venture. They're starting a startup, right? And so we focus on how African founders operate, what constraints they're facing, what capital they actually need to thrive. The structures must adapt to the market and not the other way around. Now, once we do that, we try to we focus on early stage investments, in local African founders who are solving real issues, real mass markets challenges. This could be from logistics in Nairobi to education in Lagos to HR firms in Senegal, but they are not trying to sell Rolex watches. They are trying to just sell, some time machine that could be constructed in a village, not necessarily something very fancy. So these entrepreneurs often lack access to traditional capital pathways. So we design flexible, founder-friendly structures. We usually go in with safe instruments because they don't have the capacity, to perhaps invest in, serious legal frameworks that can help real VC come in. So we are quite early. And then finally, I think more is a gender inclusive strategy and not optics for gender inclusion. So we have achieved, I mentioned in my opening that we have achieved a 50-50 gender balance in our portfolio, but this is not by chance. We did this by design. It is a tension, of course, because, global capital says, well, impact may not have the best returns and all that. We don't believe that. We believe that we are looking for the best founders, regardless of their gender. And we know that investing in women-led startups expands economic opportunity across the communities, the families, the continent. And this doesn't happen by chance. So we build it into our screening, we build it into our investment pipeline, into decision-making. We talk about it with our investment committees. And so they check us. And, those are some of the approaches we take towards early stage investing, local founders, gender-led investments.
Thank you, Joyce, and I really like that the entry point to your work is around the context. I think I'm going to come back to you with another question to really unpack this and what this means for impact on the ground. Thanks. Elizabeth, which of these learnings resonate with you?
Thank you, Femi. I think like everyone who's reading this and who will read it, who's from the ecosystem, the first thing that will hit you is that you're kind of reading about your day-to-day life, right? All of these tensions are the daily lived reality of a women-led investment vehicle manager in Africa, right? Yes, as an individual organization, you can get funded to execute on a fund mandate and have impact outputs. But an individual organization can't be asked to be thinking about the system and even shifting the system if it is not actively speaking to that system while it is doing the executing. And how I interpreted this book, again, as an ecosystem player, is that you've got Mastercard Foundation, which is now confronted with these same tensions at a different altitude, that is now producing a book to say, well, hey, now we know what you're talking about. We've now experienced what you experience on a daily basis, which I think is really wonderful. Challenging the norms while working within them is something that, I think everyone has been dealing with for a decade. For me, 10 years ago, it was around bringing investments, crowdfunding as an innovation to the space, to the market, and just realizing that I was asking all these established finance players to do things very differently, right? And that their norms were very rigid. And it wasn't Elizabeth Howard and a fintech startup that was going to change that. So the next step was like, well, how can we have this collective conversation? How can we do this collective learning thing? And this is part of why I started the Women in African Investments group, and in a sort of very scrappy, lean way, a WhatsApp group, get everyone together. And now you've got Mastercard Foundation coming with this beautiful book and saying, okay, now we have to seriously think about collective learning. How are we going to, like the book says, instill this culture of learning, given that our experience has revealed to us why the capital is moving so slowly, and therefore, where's the design mismatch? So I think it's a phenomenal book, and the exercise in and of itself to reflect this deeply and to interrogate their assumptions so deeply is just such a valuable demonstration and gesture to the ecosystem. And happy to unpack as we go through about what that means for regulations.
Thanks very much for that reflection, Elizabeth. And I'm happy because some of the questions we were asking ourselves, as we were, executing on the fund, we thought we were alone in this journey. But thank you for encouraging us with your words. And I think I'll come back to you around, what we can really do to change this. I just want to say that I have a lot of questions. But I'm just going to go one round of questions with the panelists so that we can open it up to the rest of the participants, because I'm trying to ensure that we're good with time, because right now we're not doing so well. So I want to come to you, Patrice. Patrice, and you made a point about domiciliation, and so the question is, so on the fund we had required domiciliation on the continent, and this was really a bold move. What have you learned about how this shapes investor perception and local market growth? And how can we build support for this kind of strategies among other investors?
Sure. So I think we have always supported African domiciliation. It's not just a political statement to us, it's a market building strategy. And so we 100% welcome the foundation's stance on that. And here's what we learned. First, African domiciliation signals long-term commitment. When you're domiciled in Africa, you're betting on the ecosystem, right? And so it shifts perception. You go from opportunistic capital to embedded capital. You have LPs that see that, and some may be hesitant. I think the serious ones, they respect the alignment. So that's one. I think two, African domiciliation deepens local market infrastructure, and that is crucial. Fund administration, legal services, tax clarity. I think these start to improve when more funds are based locally. I think we've seen this in Mauritius, and we're beginning to see this in other markets like Rwanda, Ghana, for example. And then third, African domiciliation challenges co-investors or to reframe the risk. Many LPs still prefer funds domiciled in Luxembourg or Delaware. I'm not sure why, but when we educate them, when we show how we manage governance, how domiciliation supports capital recycling, I think some shift their stance. So I think there's a momentum that's been built, but we still have a ways to go. And so to build broader support, as you asked, Femi, I think we really need three things: evidence, more success stories of Africa domicile funds. So it's the case of the egg and the chicken, right? Which comes first? So, but to have evidence, you first have to have the local fund managers and the local ecosystem. Second, you need transparency, clear explanations of how we mitigate risk under local structures. There is a misperception of African risk that I find really confounding, but you have to keep educating. And third, collective signaling. I think, if African GPs stand together and institutions like the foundation back this direction, it forces a re-rating of what is normal. Incidentally, I am a board member of AFCA, which is the African Private Equity and Venture Capital Association, and that's something we talk about a lot. And I think it's one of our missions is precisely to make Africa, give it a better view or better perception risk-wise, and that will, I think, facilitate African domiciliation. So to us, it's not just regulatory; it's really symbolic. And it really says at the end of the day that capital can and should be governed from here and not from abroad. So that's how we look at African domiciliation.
Thanks, Patrice. I like the point that you make that domiciliation can actually unlock opportunities on the ground. And I think with the example of Mauritius, I think that's really critical. But you've highlighted three key things. We need to, document evidence. Joy would tell you that we should use insights instead. Yeah, but transparency is also very important, and then collective signaling. Thank you. I want to go to Joy, actually. Joy, on page 20, I want to refer you to the learning book now. On page 20 of the learning book, there's a striking quote I'd like to highlight. It says, and I quote, "Is the core problem the readiness or visibility of the investment or the design of capital?" And I know you've already started speaking to that already. This really gets to the heart of how the fund challenges traditional investment norms. And so the question is, for the fund, as the fund questions the biases embedded in the idea of investment readiness, how should we redefine readiness in a way that opens doors for first-time women-led or locally domiciled funds on the continent? Over to you, Joy.
Thanks for jumping to me, Femi. I was sitting here listening to Patrice and thinking, I could do for a very long time. Love the things you say, Patrice. But I think one of the things we need to think about in due diligence is, what are we diligencing? And if we are trying to create capital markets that work in Africa, like, what then are we diligencing? Are we creating due diligence that's about ability to work in global markets? In part, it's unrealistic to not do that at all. But we need to do more that's about, what does it mean to work in context? And so one of the questions that I've been asking myself more and more and learning how to ask is, how do we analyze somebody's ability to navigate the dynamics in the market in which they work? How do we navigate the investment leaders that are in our portfolio, in the fund's portfolio, are brilliant at navigating their context. They see how power works in the context in which the companies they're investing in are working. And so if we want to think about being investment ready, what if the question was, you know your context inside and out, and you know how to navigate it? Which for us often brings up that you can see power, right? Because the reality is we're navigating situations of power, and the companies we invest in navigate situations of power, and the people who work for them navigate power. What if due diligence included, you understand these power dynamics and know when you can know what power you have and can make those choices? So it seems like that's a thing, which comes back to this last point that I really, early on in the fund life, I learned this from Eric Canau at ESP, who was just talking about the sheer reality of the crises that we're living through. And so I think one of the things we have to think about in due diligence is, how do we diligence for resilience? And that doesn't necessarily mean that we choose the one who has the most backing behind them and has the most capital under management. But you look at you look at every single woman fund manager in Africa, and what they had to do to get to that place is mind-numbing. And that resilience needs to be part of what we believe in that can actually help them navigate all of the crises that are going to come in the future.
Thanks, Joy. I think you've posed a very important question. How do we do diligence for resilience? I want to come to Elizabeth, and maybe if you can reflect on this a little bit. But my question to you is, what changes do you think are most urgently needed in the policy and regulatory landscape to unlock more African-led IVs on the continent?
Thanks, Femi. Well, there's a lot of things that we need to change, but I guess what I'll reflect on here is more the how do we change, right? And this is what I love about this book, is that I can use it so immediately and so practically in my work. So when we write regulations for investments crowdfunding is just one of the many ways that we can pool capital from individuals, right? What we are doing is writing a bunch of rules that says, who gets allowed to do the pooling of the capital, from whom can the capital be pooled, and for whom is that capital pooled. So we're in the same process of making rules, and it's unsurprisingly fraught with all of the power dynamics that Joy talks about, right? Because we start with something that is a norm and we call it best practice, or we call it global best practice, or we call it an international benchmark. And as a quote from this book, it says, these norms of investing shape the practices through which investors decide what is risky, what is valuable, which structures work, and who is ready for investment, right? And we already know in the capital markets regulatory space that we haven't done well in interrogating those norms, because we have SME segments of the stock exchange, right? In Ghana and in Kenya, and we know that we can probably count on one hand the number of SMEs that have raised capital and listed on these exchanges. And as the book says, when capital is moving slowly, it's telling us that we've got the design wrong, right? There's a mismatch. So when it comes to power dynamics, think about the room where you've got the regulator, which has all the power to decide if the local fund manager is going to get a license. Obviously, the local fund manager might perceive it as a business risk to him or herself to actually tell the regulator how the rules that they're proposing may actually prevent them from moving capital to certain types of SMEs. How do we navigate those power dynamics? And this book is great because it gives us a conceptual framework, and it gives us a new vocabulary that is just done so brilliantly by the authors that allows us to better navigate, right, those situations. So beyond the kind of actual content of the regulations, what I'm taking is the spirit of the book and its intentionality and its bravery to help myself rethink and reframe what stakeholder engagement is. And I love the book's term, a holistic systems change endeavor. I think I'll be using that. How can we redesign the whole stakeholder engagement process so that we're infusing it with elements of design that are actually going to result in regulations that will get adopted by the people who we're trying to enable here.
Thanks, Elizabeth. I think how we do stakeholder engagement, I think is what you're referring to. Okay, and I think that there's a lot that we can do from that perspective to change things on the ground. And I think maybe at this point I want to now, move the question to Joyce-Ann, who is a bit closer to the impact that can happen on the ground, given that the fund, the North Star of the fund is to create dignified and fulfilling jobs. And so, Joyce-Ann, I wanted to ask you, what can we learn from your journey in investing directly in SMEs and creating jobs on the ground, and then maybe also from the wider ecosystem about what is working, what isn't, and I really want us to center the conversation whether it's from an ecosystem perspective or investing, what is working, what is not working, and how can we actually amplify this work in ways that creates jobs for young women on the continent.
Yeah, thanks. Thanks, Femi. Those are very powerful and important points, because creating jobs, not just for young women, but for everybody on the continent is critical for the future of the continent and future of the world, really. And that is a lot of the reason why we focused this work. So just to maybe just to go first to that point about job creation. So at Chewy, we align closely with the Mastercard Foundation's vision of creating dignified jobs for women and for the youth. and for everybody really, because I'm not youth, but a job has been created for me. So our portfolio companies, we have already created about 1,000 direct jobs, and it was quite exciting to hear that, this particular Mastercard Foundation Africa Growth Fund portfolio has created 8,300 jobs. So Chewy Ventures has contributed at least 1,000 of 950 or so of those direct jobs. But we also count indirect jobs because those matter too. Because a lot of the companies are not just employing people to work for them, but they're using the infrastructure. They're working with motorcycle riders to deliver goods. They're working with truck drivers to get to the last mile. They're working with, fashion influencers to get their message across. They're working with sales agents. Some of them are even university students selling, insurance as agents. So we count that too, and we think that is very, very meaningful. Right now, Chewy Ventures, we have measured about 42,000 indirect jobs that we have created so far out of the 15 portfolio companies we have. And we believe this is really just the beginning because we're just 2 years in. So imagine how this can progress as these companies scale. So scaling the companies means scaling opportunities, means scaling the jobs, means scaling up, the impact across the continent. This matters to us. So through businesses that are locally led and solving real scalable problems, we believe we can truly make a difference on the continent. For us, job creation isn't just a byproduct. It's a core outcome of investing inclusively. So when you invest inclusively, if you invest in male and female founders, you're going to get male and female outcomes on job creation. And incidentally, that is exactly what we have created. 50% of the jobs are male, 50% are female, because the founders are exactly in that dynamic. So that's a very specific answer to your question.
Thank you very much, Joyce-Ann. I think I've tried to get us back on track with time, and I think at this point I would like to open the floor. If there are any questions in the room. Brian, I don't know if you want to guide me how we do this. But I think we can use the chat room, or are participants able to, ask questions from the floor directly?
There's actually one question already in the question and answer thing. It says, what are the panel's top 2 recommendations to mobilize private capital at scale for African SMEs to deliver sustainability? And then I think, Victoria, if it's possible, you said you put your questions in the chat. If you could drop them in the question thing, it might be just a bit easier for Femi.
Okay.
So I'm all about helping Femi.
Thanks. So do you want to start responding?
I do think. I think first question is a timing factor, which again gets to some of the tensions in the learning book, which is how to mobilize capital quickly, and then how to mobilize capital, because Joyce-Ann and many of the other investment leaders within the Mastercard Foundation African Growth Fund portfolio have raised capital from local investors, and in the end, that is sustainability. I think having friends and allies, because I think one of the things that you want in an investor always is somebody who also is an ally for you in doing the work, and also understands the context and isn't pushing you in a direction. So I think that is a longer term piece, right? And I think often we don't time things. So as my recommendation is to be clear on timing, so you don't assume you're going for the quick hit, because by the way, the quick hit isn't actually as quick as you think it is, versus investing in building a new set of relationships in different ways. I'm not sure I've named that clearly, but I do think there's a tension in that we often look to how do we mobilize private capital at scale? And then we give it 6 months versus saying, if we started now to build the right infrastructure and the right relationships, what would that look like? And nobody has to start from scratch. But the question is also, my one other piece about this that I think about in terms of ecosystems all the time is there's a set of, I've been working in impact investing and founded one of the first venture capital funds in impact investing, 20 years ago or so now. And there was always a difference between the folks who wanted there to be a field that they could participate in or to build the field that they wanted to participate in. And I think that choice is critical for people who are raising capital. Are you building the pipeline of capital for the whole field, or are you trying to find your piece of it? And I think your question, Hubert, sort of bridges those two. So that's my initial answer.
Thanks. Thank you very much, Joy. Joyce-Ann, please go ahead.
Can I just say one quick
Allow me
thing here?
to comment on this as well. Sorry. I think
Go
we were
ahead,
both.
Go ahead, Joyce. Go ahead, Joyce,
Yeah,
and then
I want to comment on this because, Joy did reference some of the work we did. So I like a comment you made, Joy, earlier that said confidence is often tied to privilege. And, I had the privilege of having had a great career in corporate banking across Africa, did over 30 years there, and built a great network. So I believe that to truly shift power, we need more African capital funding African innovation. And this is critical. So in our first close, we had about 90% of our LPs were African high net worth individuals. But what was really special was that 60% of those were Kenyan women who chose to back me as a Kenyan woman because they wanted success in this area. And they knew that we were focusing on local founders with a gender inclusive lens. So that kind of local ownership, it not only drives, success to a certain extent, but it also ensures that we have a pool of people who are very close to the problems, who are very close to the ecosystem, and we use them extensively to provide direct guidance, mentorship to our founders, etc. But I really think that these are one of the learnings that the Mastercard Foundation, Africa Growth Fund, could consider, because this is a learning fund. We are the first cohort. There's a lot to be learned here. And I think the opportunity for the foundation in the future to really catalyze more local capital into the ecosystem and give local, the large pools of local capital to take a cue that the Mastercard Foundation has de-risked a lot of their concerns on early emerging managers, local fund managers, and come to the table as well, because it takes it takes a broader base of local capital to make this really successful. And we have, the amount of youth on the continent who will not get jobs and therefore have to create startups, have to create businesses. It takes larger pools of capital, and we need more larger players coming to the party. That's my view.
Thank you, Joyce-Ann. Patrice, I would like you to reflect on this, but also there's a question here which I think you should also take. It says domiciliation in Mauritius years ago, Norway Development Finance excluded Mauritius because of tax haven issues. Has this view changed? So you can reflect on this and also reflect on this question.
Sure. So I just want to, a brief note on this issue of catalyzing local capital. I think there are levels to it. Joyce-Ann, you've been backed by Kenyan women, and that's great. And I think, when we talk about angel investing and, that is important. But we also need to push that at the institutional level. I think African pension funds, insurance companies have been sitting on the sidelines, and they let, international investors come in, and they need to play a more active role. In our first fund, we had 1. In our second fund, all of a sudden we had 4. And that, I think, is, if we want the success and sustainability, we need to have domestic institutions step up. So, I just wanted to add that bit. Now, with respect to Mauritius as a tax haven, I think there are misconceptions. So it's interesting that Norway, which is outside of Africa, would say that, yet the African Development Bank, which is one of our investors, insists on us domiciling our funds in an African institution and accepts Mauritius as one. So, there were issues with respect to tax alignment that the Europeans basically took a strong stance on at some point, but that has been resolved. So I think it's important to claim. And lastly, just from pure experience, opening an account and a company in Mauritius is 10 times harder than doing so in the US. I can tell you that from experience. So, we need to be careful about labeling without having all the facts. That's my view.
Thank you. We need to be careful about labeling before the facts. Elizabeth, I'm going to give you the last question because of time. And I think it's a question that says, what has the panel learned about how perceptions of African markets and African fund managers, especially female, inform investor behavior? And what can we collectively do to drive perception and mindset?
Yeah, such a great question. And I think perhaps others on the panel can speak more to it. But, last year we put out a report around mobilizing local capital and why local capital in particular was so important to female-led investment vehicle managers. And we spoke about the types of companies that these fund managers were targeting. And I think, similar to the report, tackled why the capital that they need to deploy has to be flexible. We have to have a range of investment instruments. Why it is important that it's in local currency. Why it's important that it's not just debt or equity, and that it's flexible. And if you work backwards from kind of those constraints, you really can't get very far with foreign capital, USD capital in a traditional structure. Okay, so this issue of mobilizing local capital is critical for and disproportionately for women-led investment vehicle managers. So, this opens up a question, and to your point, what can we collectively do? And to sort of go to Hubert's question around what can we do at scale, we can't scale anything into a dysfunctional, broken ecosystem. We can't scale anything until we've had a conversation at the collective level. So, one thing that I hope this report catalyzes is the larger players, while we're doing the investments crowdfunding, while we're organizing the angel space, while we're doing the diaspora organization of capital, that the big players actually join or put in place platforms for collective learning. And we already have some, right? Catalytic Capital Consortium, Growth Firms Alliance, etc. And put in place a cadence of collective learning. Because the way that we're doing it right now, which is inefficient and dysfunctional, is also very costly. And these female-led investment leaders are actually absorbing the cost disproportionately, which I find quite unfair. So, one thing that we need to do, I think, is alleviate the burden or split the burden a bit more fairly. And in doing so, we directly sort of inject resilience back into this ecosystem of women in investment vehicle managers, because if they can feel that they're not having to educate at scale everyone about these differences, then they might think, okay, I've been banging my head against a wall for 5 years, but now that we're having this conversation and it's not only me saying it, maybe I'll stay in the game, So this is what I think we can do collectively.
Thanks, Elizabeth. I think we can take maybe one more question, and then maybe I'll allow the panelists to respond, all panelists respond to this question, and then maybe give your final note on the discussion. I think I'll pick this question. It says, how do we create trust and verifiability in African capital markets without always relying on foreign intermediaries to validate risk, manage custody, or control flows? Who would like to go first?
I don't mind taking this one first. I think one of the things we have to do is first develop confidence in ourselves, because yes, we keep complaining about, foreign institutions coming in, for example, but let me give you a simple example. Rating agencies. There are homegrown rating agencies in Nigeria, in Francophone Africa, but yet when they come out with ratings, people tend to, not quite trust them, but they'll trust Moody's and S&P. Yeah, I'll name them, I think it's important that by that building this ecosystem, we develop the confidence. And we'll stumble at times, no doubt. But we have to basically say, I will go to the people who are the experts and they're local first. That to me is, so it may be a glib answer, but I think confidence in ourselves is the first starting point. If we don't have it, then everything else doesn't matter.
Thank you. Joy, over to you.
I don't think you chose the low-hanging fruit question, Femi. Well done. That was the more complicated one. I was on a panel years ago where the whole panel was bemoaning the decline of trust in public institutions. And my answer was, well, this is kind of good news because it means the discontent with the existing institutions means people will push to build ones that might work better. And I do think anytime we have sort of moments of disruption, which clearly this moment in time is a moment of disruption, that you need to rethink and sort of, we need to shift the narratives around trust. And Patrice, you said it really well, but I think there's something about why do we trust something because Moody's behind it? Because we still do. We say we want something local, and then we say we want all of the, there's always a tension, right? Because people want to challenge things, but then they want safety, even if they know that the things that they think are giving them safety don't. And that's a place that we live in all the time, right? And finance is so driven by trust, right? It is terrified, right? My ability to make money in finance, full stop, is not about today, but is about the future. Do I do what I thought I could do today? And so that I can say I have a track record and I can do it in the future. Anytime disruption comes into that, confidence declines and then trust declines. But we need to start putting out other things that are trusted, like knowledge of context should be more trusted, right? People who are shifting power dynamics to be more just, to work for more people, should be trusted. But instead, they're seen as suspect because they're not working within the systems of capital as we know it today. But I think it's tied to the norms, and it's a really tough thing to unbundle, particularly for people who work in finance, where if they say the wrong thing, if they don't sound like they're working within every single system that exists, they get dismissed.
Thanks, Joy. I think, go ahead.
I just wanted to say that, and to rebound on Joy's point, I think the one elephant in the room is public policy and regulation. I think if regulators are seen as arbitrary, then everything else is going to be tarred with the same picture. And that's, so there's a very special focus that has to be on, are regulators fair? Because if regulators are fair, if a financial institution is not working properly and is punished or fixed, properly, I think that will give confidence that yes, if something goes wrong with a local institution, I know that there's recourse. And so, countries that get that, I think have less of an issue with confidence in local institutions. So policymakers, I think, should be at the table as well, because they have their role to play in creating this confidence.
Thanks. I think a few things are emerging. First, to your point, Patrice, we need to be confident in ourselves. And there are norms that need to shift. Joy, you're mentioning that the knowledge of the context is important. And then policy actors coming to the table is very important. Elizabeth, Joyce-Ann, I don't know, do you want to reflect on this?
I'm happy to. I'm happy
Okay.
to. Trust in investing in early stage fund, in early stage founders is challenging. I mean, I don't want to understate this. I was in banking, and finance relies on trust, but obviously with larger institutions or larger pools of capital, you can rely on a lot more. You can rely on collateral, you can rely on real data, but when you're investing in startups, early stage companies, you have to rely on more than what is publicly available, because these are private entities. And really balancing the trust element is sometimes the hardest part of early stage investing, especially when you're working with newer companies and unconventional structures like private equity VC. So actually, how we address this is that we address this by anchoring in clarity of purpose, number one. Our job is to back founders who are building local realities. Yeah, that gives us the confidence. And you're talking about confidence to move quickly and then, align. So when we are aligning with our thesis, we become very clear. And then we also have to go out and confirm what we have seen in writing. We have to confirm what we have been told by the founders. So we actually do physical verification. We meet the founders' employees, we meet the founders' customers, we actually meet with the competition as well. Everything is very, very physical. We look at not just their financials that they have given us, but we ask them for what's in the bank. We like to measure what's the financials with what's in the bank account, because sometimes, financials could be as good as a piece of paper they're on. And a lot of these early stage companies may not afford, heavy duty auditors. They can't afford the Price Waterhouses. So there are various other ways that we can get more reliance, especially for early stage founders. And I think we owe it to our markets to do the work. That's my view.
Thanks, Joyce-Ann. Elizabeth.
Yeah, thanks, Jeremy. Yeah, I loved all these points, and just to echo what Patrice was saying and connect it to what Joyce was saying, in the regulatory space, depending on the starting point of an individual regulatory authority, the way in which one can leverage the incumbent trusted actors, like the traditional finance actors, for the benefit of building trust between the regulator and new incoming private sector actors, new fund managers, is important. For example, in Nigeria, you've got quite a negative equilibrium right now, where the private sector actors don't trust necessarily the regulator and some of the financial institutions. They believe that there's sabotage. They believe, that their government interests, whatever, and they're stuck operating outside or finding workaround regulation, right? And then you kind of wonder what that repair looks like. And if the regulator does trust the incumbent traditional finance players, then can they, as part of this collective learning, bring their AAA ratings and whatnot to the table to say, hey, you know what, we're I don't know, the IFC, the World Bank. We've been trying to, boost agribusiness for 20 years. We've been trying to invest in SMEs for 20 years. We figure out we can't do it because we can only invest in USD and we can only invest at this size. So we're looking at supporting a new set of intermediaries, maybe women-led IVs, that are doing things a little bit differently. We haven't figured out how we can support them, but you know what? We are going to use our brand IFC to encourage you as a regulator to have another look, to have another conversation and to reset, okay? So another example of how we're all ecosystem players. The regulator is an ecosystem player. Mastercard Foundation is an ecosystem player. We all need to understand what our role is in shifting this power.
Thanks, Elizabeth, and thanks to all our panelists. I want to close the curtain here by, asking that each panelist, give us in 1 minute, the last passing shot. And I would maybe want to recommend that it's more like a call to action. We started the conversation talking about 3 tensions: executing while learning, creating direct impact while shifting systems, challenging norms. And then we've also had, flash conversations around domiciliation. We've talked about language, and especially around investment readiness and the underlying power dynamic in there. We've also now, talked about trust. And then we've also had rich conversations about, how all of these, ecosystem activities from, regulation and all of that, what it means for jobs. So I'm going to bring you back to the learning book and then ask everyone in 1 minute to just, what's the call to action from this? What are we asking everybody, to do as we're going to leave this conversation today? I don't know, Elizabeth, you want to start?
Sure. So, if you're on this call and you do represent a large capital allocator, maybe a DFI or a donor, my call to action would be to embrace your role as an ecosystem player and a learning partner, and to not silo in your learning and knowledge function to your own organization, no matter how big it is. Figure out how we can build a collective learning function and a culture of learning as an ecosystem.
Thank you, Elizabeth. Patrice.
Well, if we're here today, it's because the Mastercard Foundation, MEDA and the partners basically decided to publicize, make very public their lessons. And I think that in and of itself is a lesson for all. As I stated earlier, we at Affic Funds do postmortems all the time, lessons learned from our first fund, lessons learned from our second fund, but except for our LPs, we're not sharing it. So I think, this to me is something I'm learning, and maybe we should just write a paper and publicize it. And, of course, anonymize what needs to be anonymized, but really say, guys, this is what we did, this is what went right, this is what went wrong. And I think if we all do that, we're all the better for it, because we will then have a body of knowledge about what investing in Africa means, and we can learn from each other. So the call to action is to not be shy and to share.
Don't be shy. And don't be shy and
don't be shy and to share.
Don't be shy and to share.
Right.
Okay. Joy, I'm keeping you for last. Joy-san, go ahead.
Sure. Great points here. I think the one I would talk about is the urgency of direct impact. We are living in unusual times, and Africa is going to go through even more unusual times simply because of our demographics, simply because we have educated a lot more youth than ever before, who are emboldened with mobile phones and access to data and access to the internet, and know what it means to have a meaningful life. And we need to create jobs. We need to do things that have impact. Deploying capital comes with a lot of responsibility, and with a lot of responsibility, we need to track great change. So for me, it is the urgency of direct impact that I believe we all have a responsibility for.
Thank you very much, Joy-san. Over to you, Joy.
So many different calls to action. I've got a whole list, and I keep reprioritizing which one to say. So I might just take 2. One is that I do hope that a piece of the learning book for all of you overall is to look at power. I mean, that's a theme throughout all of this, is to recognize the power dynamics. And I know that there's a robust conversation within the ecosystem around the power dynamics around this very fund. And I think the question is, how do we have that conversation? And not only, I think this was an effort for us to look at what have we learned from the last few years, and what might pathways forward look like. But I think that's equally, to Patrice, your question, that's a question all of us can ask, right? Where am I positioned within the ecosystem? What more can I do? Where can I shift how I'm in relationship? What power do I have to influence others in a good way? And I think as we move into the next couple of years of the fund, we're really going to be digging more into ecosystem engagement, because we have more space for that now, right? We're sort of towards the end of deploying the capital. It's not that we're done or that but we're getting towards the end of that. And I do think some of these lessons hopefully will create an open engagement for people to join us in thinking about these. And I know one of the things, for example, that we're thrilled to keep talking about is we see, and Criterion looks at this globally, but we see amazing advanced practices within the investment leaders that are in the fund. We want to publicize those, and we want to talk about what other advanced practices are emerging on the continent so that we can hold up what works and what should be the standard of practice, and be able to counter the current standards of practice, some of which are good, but many of them are flawed and we're caught working within.
Thank you very much, Joy. And I think to just sum this up, to your point, Joy, I think you're calling us to look at power, and then recognize where we are in that, and then maybe to add to that is to say, what do you do with the power in ways that shift norms? Thank you for that. And Elizabeth started us off by saying, embrace your role, and we should not work in silos, but rather we work together. Patrice has kept on telling us, keep writing, evidence, storytelling, keep writing, don't be shy, and to share. And I like that, Joyce-Ann has kept us grounded, the urgency of direct investment. It reminded us that we have a more educated young population, especially young women on the continent. And there's an implication, if we direct capital through investment vehicles on the continent and to SMEs, who are the ones on the ground, unlocking these opportunities for young people. Thank you very much to all our panelists. Can I ask, a round of applause to all our beautiful panelists for sharing their thoughts and ideas with us today. Thank you so much. We just have a few minutes to close out. I just want to ask that we, take part in a very quick exercise. Let me know if you can see my screen. We would like that everyone, quickly scan the QR code. We have just a few questions in there that would like your response and feedback on. Okay. Let me see if we're there. Okay. Yeah, there are a few questions here that would like everyone to, share your thoughts on, in one word or idea. What's one word or idea that stuck with you so far? Two people. Beautiful. How has your thinking shifted during today's session? How has your thinking? Okay. I think that's, what feels most possible for you to act on next? And what questions are you still holding on to? How would you like the fund to engage with you in the future? Yeah, okay. So I think those are the questions. I'm going to put this back here so that everyone can, And we'll give everyone like 2 minutes very quickly to scan.
Then you have to run through it on your side so that the questions display as you run through it.
Yes, I just want to be sure that everyone has been able to scan the QR code. Okay. Great. Learning, confidence, documenting, building the road, tensions. Fantastic. Okay. Share. Yeah. Power. Conventional structures. Interesting.
I love Femi. Local was coming up farther and farther to the center as it was getting bigger. That was
Local, yes. Yeah. Okay. We give 1 more minute to everyone. Collective learning. Beautiful. I think learning stands out. And it's shown in multiple ways, you know. Learning. I think local is taking over. Interesting. Okay. Collective learning. Okay. Thank you very much, everyone, for engaging with us in this session. And we just want to remind everyone, okay, what feels most possible for you to act on next? Start an internal conversation. Explore a new partnership. Okay. Great. What's the fastest way to boost local financing? Okay. We would really like everyone to, participate in this, but I'm just being mindful of time. I just want to remind everyone again that you can download the learning book by just scanning this QR code and get to read it, engage it, and we're open to, getting your thoughts and feedback. I think it's also important for me to note here that, we're really looking forward to engaging with everyone. As Joy mentioned, we're, looking forward to engaging with you all based on our new ecosystem strategy. And I think
just for me to throw in one other piece there, just to name, this is the first of 4. I named that in the beginning, but this will probably be the most in-depth one for now. We'll see how they go. But another one on value creation, BDS, and so the second, a third one will go out that's going to be about ecosystem learning and ecosystem engagement, and then a fourth about creating jobs in local context, building stronger economies. What have we learned about that? Which will also, somebody's question was around sort of what have you learned about, how do you measure impact, and that one will dig into some of the things we've learned around that. And again, these are all midpoint reflections. They're not the final evaluation. We're not done. We're just trying to say what we've learned to date. But if anybody has feedback on what you might want in those to make them work, we can't overpromise, but would always welcome feedback if there are things that you might want to have them be different in those.
Absolutely. Thank you so much, Joy. Thank you to all our panelists. Thank you to all our participants. Thank you for taking the time to join us today. From the conversation we have had on the lessons shared from the fund over the last 3 years, moving capital is not just, a technical exercise. It's a profoundly human and political one. It's about who gets to decide, who gets included, and whose vision of development we must invest in. What we have learned on the fund is that if we are serious about shifting power, then we must go beyond the surface of inclusion and actually reimagine how investment structures are built, who leads them, and as well as how success is defined. This essentially is an invitation to keep questioning, to the point, we need to keep writing and keep sharing. So we need to keep questioning our assumptions, particularly about risk, readiness, and returns. It also means backing bold ideas, to Joyce Ann's point about the urgency of direct impact. It means backing bold ideas that reflect the realities and aspirations of young people, young women on the continent. This work is hard, it's complex. I call it a wicked problem. But the context we operate in is, constantly changing. But complexity is not a barrier. It's an invitation to collaborate. It's an invitation to reflect. And it's an invitation for us all to act with courage. So let's continue to build an investment ecosystem that's fit for purpose, rooted in context, and accountable to the futures of the young women who we are, in this to serve. And on this note, and on behalf of MEDA and the Mastercard Foundation Africa Growth Fund, I want to say thank you to everyone for being a part of this conversation today, and enjoy the rest of your day. Please take a moment. You can continue to, fill in the questions that we have requested that you ask. And then if you have feedback, if you're seeking access to the learning book, please reach out to us. We're happy to respond to you. Thank you very, very much, everyone, for joining us.
And thank
today.
you, Femi. Thank you so much, Femi.
Thanks,
Thanks,
Joy.
guys.
Femi.